Okay, so get this. Benjamin Graham, the so-called Dean of Wall Street, once compared investing to picking up cigarette butts off the street. Not exactly the glamorous image you'd expect from a financial genius, right?
That's such a vivid metaphor. I mean, it's not what you picture when you think of Wall Street legends, but it really captures the essence of his strategy.
Exactly. Graham's cigarette butt investing method was all about finding stocks that everyone else had discarded, companies that were undervalued to the point where their market price was less than the value of their tangible assets. It's like finding a nearly spent cigarette with a puff or two left in it. Not glamorous, but profitable.
And it's fascinating because it's not just about being cheap for the sake of cheapness. He had a very specific formula for identifying these opportunities, didn't he?
Oh, absolutely. Graham's approach was meticulous. He looked for stocks priced below two-thirds of their net tangible assets per share. And for an even stricter standard, he'd focus on those priced below two-thirds of their net working capital.
Those terms, net tangible assets and net working capital, sound pretty technical. Can we break those down a bit?
Sure, net tangible assets are essentially the total assets of a company minus its total liabilities, intangible assets, and goodwill. So, it's the hard physical stuff the company owns minus what it owes, and the intangible things like brand value.
And net working capital?
That's net tangible assets minus fixed assets, like buildings and machinery. It's essentially the liquid assets that can be quickly turned into cash.
So, Graham was hunting for companies that were ridiculously undervalued compared to their actual, tangible worth. But it wasn't just about the numbers, was it?
No, it wasn't. Graham understood that just because something looks cheap doesn't mean it's a good deal. Let me give you an example to illustrate this.
Please do.
Imagine there's a factory. The owner spent $10 million dollars on land, buildings, and equipment, hired workers, and got everything running. Then, for some reason, he has to sell it all for just $5 million. dollars.
That sounds like a bargain. You're buying $10 million dollars worth of assets for $5 million. Dollars. Flip it, and you make $5 million, dollars, right?
That's the natural thought, but it's actually wrong. Think about it. Why would the owner sell it to you at such a low price?
Probably because he couldn't find anyone willing to pay more.
Exactly. And even if you do buy it, you might not know how to run the business. The machines could rust, workers might quit, the site could grow weeds, and the roof might start leaking.
Oh, when you put it like that, it sounds like a nightmare.
It is. It might take you 5 years to find a suitable buyer, and during that time, you'd be paying maintenance costs and transaction fees. In the end, you might only get $6 million, dollars, or even less.
So you're saying that even though it looks like you made $1 million, you could actually lose money?
Exactly. Because money has a time value. What could you have done with that $5 million dollars instead?
You could have put it in the bank or into a low risk investment and earned a guaranteed return.
Right? After 5 years, that $5 million dollars could have grown to $6.08 million dollars with a 4% annual return.
Wow, that comparison is striking. So, on paper, you made $1 million, but in reality, you lost $80,000 compared to what you could have earned elsewhere.
Exactly. And that's where Graham's cigarette butt method comes in. He wasn't just looking at total assets. He focused on assets that could be quickly liquidated.
Assets that could be turned into cash without much hassle.
Precisely. Let's try another example. Same factory, same $10 million dollars in land, buildings, and equipment. But this time, the books also show $3 million dollars in near maturity bank wealth management products and $6 million dollars in accounts receivable.
Accounts receivable?
Think of it like money owed to the company by reliable entities, like big banks or telecom companies.
So, almost guaranteed cash.
Exactly. And let's say the company also has a $1.5 million dollars bank loan. Now, suppose this company is sold for $5 million. dollars.
Would you still lose money in this case?
Not at all. Just by collecting the $3 million dollars in wealth management products and the $6 million dollars in accounts receivable, you'd have $9 million. dollars.
Pay off the $1.5 million loan, and you're left with $7.5 million in hand.
Subtract your $5 million dollars investment, and you've made a $2.5 million profit.
And you still have the fixed assets, which originally cost $10 million, as a bonus.
Exactly. That's the essence of Graham's cigarette butt method.
He wasn't buying the whole business. He was buying the cash and liquid assets on the books.
Right. But Graham also understood that if a company was selling itself so cheaply, there had to be a reason.
Like, why wouldn't the business owners know their company was worth more?
That's the key. And to understand why Graham's method worked, you have to look at his life story.
His life story? How does that tie into investing?
Oh, it ties in completely. Benjamin Graham was born in London in 1894 to a Jewish family. When he was just 8 years old, his father died, and the family business went under.
8 years old and fatherless. That's tough.
It was. His mother tried to make ends meet by running a boarding house and speculating in stocks.
Speculating? That doesn't sound promising.
It wasn't. In 1907, she bought shares of U.S. Steel on margin, and then the market crashed.
The Panic of 1907.
Exactly. The market was cut in half, and although it recovered by 1909, her account was wiped out.
Because of margin trading?
Yes, leverage amplifies gains, but also magnifies losses. That failure devastated the family's finances.
What a difficult childhood.
It was. But Graham's uncle Gerald, a mathematics professor turned engineer, stepped in to help. He had a huge intellectual influence on Graham.
So Graham was good with numbers from a young age?
Very. When he was just 12 or 13, he tutored a classmate in math and earned 50 cents per lesson.
That's impressive.
It is. And that mathematical talent laid the foundation for his investment career.
But his journey wasn't without setbacks, right?
Not at all. When he started working on Wall Street in 1920, he managed his uncle's pension fund. But when the 1929 crash hit, those funds were heavily impacted.
Did Graham recover the losses?
He did, and then some. But his uncle had already passed away by the time he turned that money into a fortune.
That's heartbreaking.
It is. But it also shows how deeply Graham understood market risks. His experiences taught him the importance of a margin of safety.
And that's a cornerstone of his investment philosophy.
Absolutely. Graham's life was a testament to the idea that true investing wisdom comes from understanding risks and thinking rationally.
From a fatherless child to a Wall Street legend, his story is truly inspiring.
It really is. And it reminds us that investing isn't about chasing quick riches. It's about sustainable, protected returns.
Slow and steady wins the race.
Exactly. Graham's legacy isn't just his investing methods. It's the mindset he instilled in generations of investors.
Including Warren Buffett, his most famous disciple.
Without Graham, there might not be a Warren Buffett as we know him today.
And that's a thought worth pondering.
It really is. Graham's story is a reminder that even in the toughest times, rational thinking and diligent study can pave the way to success.
A timeless lesson for all of us.